Hi, this is Lex, and welcome to the Fintech Blueprint. It's your podcast about fintech, decentralized finance, digital banking, investing, robo-advice, artificial intelligence, and all the other frontier technology that is transforming financial services. To get more content, like an illustrated transcript of this conversation in your inbox, subscribe at fintechblueprint.com. So without further delay, let's jump into today's episode. Hi, everybody, and welcome to today's conversation. I'm really excited to have with us Aman Behzad, who is the managing partner at Royal Park Partners, which is a fintech corporate advisory firm. We're going to talk about the fintech and crypto capital markets and understand the current state of what it's like to try and get some corporate finance done for fintech companies. Aman, welcome to the conversation.
Hey, Lex, thanks for having me.
My pleasure. Tell me a bit about how you got into the banking business. What was your early experience and kind of what were the things that brought you to focus on financial institutions?
I actually started my career on Wall Street back in 2003, a boutique investment bank called Marco Polo Partners. Very interesting place. Can't say I really knew what I was doing when I took up the internship. I was studying at a university in the UK. Opportunity came up to do an internship in the US on Wall Street. I jumped at the chance. 2003 was a really interesting time. The US was still sort of reeling from post-dot-com bubble crash. A lot of interesting things were happening and sort of re-examining the world of tech. And we were sort of sitting at Wall Street advising a lot of businesses that were mainly operating in the technology services space and sort of working through the processes of digitalization. And that's what really got me interested in tech initially. And so I was looking at a lot of services businesses that were looking to digitize kind of old school processes around processing of healthcare benefits, around tax returns, etc. And so there was this big wave of digitalization that I thought this is really going to be something. I wanted to be part of it. Worked for the firm. One of our largest clients was Lehman Brothers at the time. They decided that they wanted to retrench a little bit from sort of the emerging markets activity that we were focused on in terms of pairing up emerging markets companies with core services providers in the US. And so I was unsure about where the business was heading. My father told me to get back onto a plane to the UK and do some formal training and become an accountant, trained and became an auditor, but again, joined the technology team of KPMG and then followed that technology journey where we worked with a number of different tech and then ultimately fintech clients. Followed that journey through to Citigroup, where I ended up joining a very nascent fintech coverage effort outside of the US, worked on a couple of card processing deals, saw the WorldPay transaction take place, advised Network International as they were being spun out of Emirates NBD, and I thought, this is pretty interesting. It's a part of the market that nobody's really taking a look at, nobody's really servicing. And wouldn't it be interesting to sort of try and make a career out of this, an area of the market where the financial services bankers didn't want to touch because they were very purist, looking to only work with asset managers, insurance companies, and banks. And the technology guys were just too focused on sort of internet companies and enterprise software. So there was this really big gaping hole that I thought could be quite an interesting part of the world to navigate for the next 10 or 20 years.
I'm going to ask you kind of a tongue-in-cheek question, which is, you spent quite a bit of time at KPMG getting trained in accounting, and then you went back to investment banking. How much of investment banking is like hard financial analysis? How much of it is strategy and creative thinking? And then how much of it is sales? Like, how would you split the day-to-day? Or like, if you look at people who are successful, which bits are important?
I say part of that is so it's not a simple answer. I think that there's two vectors that determine the relative level of importance. One is the vertical that you serve. So by that I mean, is it a much more mature part of the market? So we're talking about the oil and gas sector, telecommunications, where let's say there's kind of a much more well-trodden path around how those businesses should operate, the kind of core valuation fundamentals, how to realize and generate value out of those businesses. For those kinds of verticals, core financial analysis is very, very important, and strategy is very important, and probably a little bit less so the sort of the sales routine, because as I said, value is quite well understood. If you're talking about the technology vertical and then specifically financial technology and more nascent sub-verticals within that, including AI, etc., where Financial analysis is much harder because those businesses and those sectors are not mature enough. It's much harder to talk about strategy because these aren't as well-trodden industries. So people are really making first steps and strides in terms of what they should do next. There isn't a playbook of how to operate an AI company or a playbook of necessarily of how to operate a certain kind of fintech company. And then the sales element just becomes much, much more aggressive. You're really, there's an old saying that you're sort of really trying to sell the sizzle, not trying to sell the steak. And that's where that really comes in, where the role is more sales heavy and really talking about sales and strategy together than core fundamental analysis.
Let's move to a discussion of the capital markets and fintech. One argument to make is actually fintech is pretty dead. There's nothing interesting going on. We've had since 2008 kind of the consumerization or the Web 2 approach to putting financial software into the cloud and into kind of an internet distribution chassis. And yeah, it's largely done. There's lots of fintech apps inside of phones. And then valuations got ahead of us. Things got really expensive. And since they've collapsed 90% in many cases. And so there's not really anything left to do. And I think the skeptics, the people maybe inside of the bulge bracket banks that had enjoyed a skepticism of the digitization story were proven right by the collapse of valuation multiples from 50x down to 2x. Why is that wrong? What are you seeing in the fintech capital markets that are interesting and that kind of give you a reason to go on with the business?
So I think what's important to realize are just some core fundamentals of the fintech market. And you'll always see sort of dips in terms of funding, IPOs, etc. What that doesn't ever tell you, or dollars being invested in any given quarter, what that doesn't tell you is the raw lived fact of working at a bank or an asset manager or an insurance company. When COVID-19 hit, and again, telling this via anecdotes, happy to back up with data. But when COVID-19 hit, Lloyd's of London, which is in one of the largest insurance markets in the world, specialty insurance, their issue was not how to manage remote working, as was the case for other banks and other financial institutions, which I think in itself is a pretty strong indictment of how these companies operate. They actually didn't have laptops for their employees or the people who were working across the Lloyd's of London different syndicates. Everybody was working on a desktop. And so the whole concept of a laptop and working and dialing in, connecting into work remotely was something that nobody had ever thought of before. And we're talking about 2019 here, talking about a few years ago, just as the COVID pandemic was hitting. So, these are lived facts about just the level of digitalization, the level of advancement of these organizations from a technological standpoint. Much of the technology stacks that exist in banks, asset managers, are cobbled together by technology that was written in the mid to late 90s. Much of this is in COBOL 1, let alone COBOL 1, COBOL 2. Those engineers, those software engineers are sort of in their 60s and 70s now, who are the ones who are able to produce, who are able to change and update and upgrade internal systems. So again, whilst we see sort of big shiny IPOs and unicorn rounds as being indicative of what's going on in the fintech market, the lived reality is the vast majority of the population of this country does not have access to, at their fingertips on their mobile phone, basic financial services. If you look at internet mobile penetration in emerging markets, obviously the issue is much more acute. And so we really, really are just rounding off, I think, the first innings of the financial technology wave. This is a multi-decade, trillions of dollars of problems that are being solved and will not be resolved, or will continue to resolve, but will not be resolved in any time soon. This is 20 to 30 years of work that lie ahead of us to be able to refurbish the global financial systems.
Okay, let's approach it maybe from another angle, which is your firm publishes weekly, monthly, and quarterly research about the space. And if I look at some of the trackers that you put out versus January of 2022, capital markets, wealth management's down 14%, payments are down 28%, insurance is down 40%, banking and lending is down 49%, and crypto blockchain companies are down 70%. I think these are your public comps. Tell us the story. What's going on?
So I guess it's a well-known story, but much more acute in the world of financial technology. whereby ZIRP, kind of zero interest rate policy, bred this system whereby returns anywhere were junk. And so you needed to go for asset classes that had much more promise of future returns. And you leapt from you leapt from sort of safe asset classes, developed markets, let's say oil and gas technology, oil and gas sector, telecommunication sectors, industrials, to first technology. But actually, when you realize much of the technology sector in itself now is getting to so the larger enterprise technology scalers have got to a certain size and scale where they are themselves also subject to, they've also been massively bought and also seem expensive. You have to go to even more emerging asset classes that sit below that. So sub-verticals within technology, things that are very capital consumptive, require a lot of money, require a lot of funding to be able to see them through to becoming sustainable businesses. Financial technology, AI, Web 3.0 type companies, much more emerging technology businesses where future returns will much further over the horizon than what was available today. And so that contraction, when interest rates rose, there obviously needed to be a retrenchment and a contraction of funding from across the market. Flight to kind of let's call it quality, but more like, I think the right word more is a flight to higher cash flows and near-term returns. And that flight to higher cash flows and near-term returns is hard to come by outside of the hyperscalers in the world of tech, outside of the Apples, the Googles, the Amazons. And so you saw this massive contraction, a pullback of both public market investors, but also private market investors from fintech overall as if you can call it an asset class, as an asset class. And so that risk off mode where we went into deep freeze during 2022 and really emerging into Q1 2023, saw all the money flying out of smaller financial technology businesses that were listed on public markets. I think what's more interesting is the year-to-date performance that we've seen in the public markets. Again, we're riding at all-time highs. I think there's been a secular rotation back to growth on the part of long asset managers and actually also hedge funds for that matter. If you look at capital markets, wealth management companies year-to-date, their stocks are up about 13% on our capital markets wealth management index. Payments companies are up 18%. Insurance technology businesses are up 16%. Banking, lending are up 19%. So we're really recovering a lot of the dramatic losses, let's say, that we had in 2022. I think we've sort of recovered the part of the selling where it was clear that the stocks were being oversold. I think we're probably back to where we really should be. And I think we'll continue to gently and incrementally move up and to the right over the next 2 or 3 years.
It used to be that the Fintech index was like Visa and MasterCard. And so you have these hyper large market caps. And now we have lots of other stuff in there, from SoFi to Robinhood to Coinbase, lots of smaller companies that behave differently. But if you were to kind of decompose performance of the public Fintech index, is it just, higher volatility beta? Like if you were to just get the S&P and lever it up, would that generate the same returns? Or are there idiosyncratic sensitivities and factors that you're seeing within the fintech's universe? Like, yes, you get more beta to the market, but you also have exposure to interest rates or exposure to some other things. Like, what are the drivers in your view?
Yeah, look, definitely more beta to the market for sure. Whilst we have a quote unquote fintech index, there's obviously a wide variety of companies that are in that index. B2B businesses, B2C businesses, B2B2C, companies focused on all kinds of different verticals within the fintech sector, businesses that look more enterprise in nature and businesses that look much more consumer focused in nature. And so I don't think you can really say that you get the same, that just by levering up S&P 500, you get sort of similar returns to what our fintech index is demonstrating and giving. And actually, if you look at year-to-date performance against the S&P 500, quote unquote, the fintech index that we have is, call it 3% behind S&P 500 on a year-to-date basis, but about 3% above month on month. So I think our fintech index will bob in and around where the S&P 500 is. I think what's more interesting is if you sort of really bifurcate those businesses in our index to B2B versus B2C. The B2B businesses will always have much lower beta, will always track and trend much more in line with general SaaS companies in the market, horizontal SaaS companies, with enterprise software businesses, and be more mooted in their upswings and downswings. The B2C businesses, which are much more capital consumptive, much more dependent on market factors in terms of their ability to raise money from public markets, debt markets, to be able to fuel and fund their activities. When the ease of financial flows is there, these businesses really shoot for the stars because they can deliver growth and metrics at a speed and velocity that the B2B businesses really struggle to or just can't. But equally, they get really hammered when there's any kind of contraction in the market. And so we've seen very strong rebound on the part of B2C stocks. And year to date, we're up 29% on our B2C index versus 16% on the B2B side. But if you look at where we were versus January 2022, the B2C stocks are still 30% below where they were, whereas our B2B stocks are only down about 7%.
Interesting. And there's like this whiplash also between different investor perceptions in different markets, like the public market and the private market, where, private investors are burnt on their sort of wrong bets in B2C or their B2C bets that have collapsed. So they've switched into kind of funding the infrastructure. But then at the same time, like, B2C is kind of where you make your glory, like it's trying to create these hits. Similar to a media business where you produce lots of shows, but you're hoping for like the one hit that becomes so culturally relevant and popular. And you see brands, whether it's Revolut or Robinhood or Coinbase or any of these champion brands that emerge, like they do capture the popular imagination. And that does kind of happen like a fashion. It's much more difficult to control than the infrastructure laying, which is more survivable. I have a question about multiples for you to follow on the categorization you gave. So when I think back to like 2014, a good company was raising at 10x to 20x revenues. And 10x was really good. So a company that was showing traction, showing revenue growth would get a 10x on revenue. And then SoftBank and Ribbit and Tiger and Andreessen discovered Fintech, or maybe Fintech discovered them, I don't know. And these multiples started going from 10x to 20x to 50x to 100x at the top of the crypto market, 200 to 150x. And the story of blitzscaling companies, the way you blitzscale Uber, the moment that you see a market that there's any product market fit, you have to deploy $100 million to corner the market and knock everybody else out. And that became the mantra, that you had to blitzscale into all of these spaces pretty much immediately, and there was sufficient capital to burn and do that. And now valuations are not at 100x at all. In the report that I'm seeing from your firm, it's between 2 to 5x is kind of the wiggle room. Can you talk to me about this change in valuations? Like, is my story right? What's wrong with it? Are we ever going to see kind of that level of optimism again? Are we going to see capital being as sort of permissive or irresponsible, or are we like anchored at a much lower number now and that's just how things are?
Look, investors and investor sentiment is typically very short-lived. Like people's memories are very short. So within 6 to 12 months post a period of instability, volatility, etc., everybody starts looking to the future and immediately forgets the past. And so we went from a world where, let's say, as you said, 2014, before, investing was very much still based on fundamentals. Now, it depends on what stage of investing it was. Seed, Series A, and to a certain extent, Series B was hyper local teams, local people being on the ground, doing reference checks on management teams, seeing what else they've done in the past, really getting to know the ecosystem, the community, the customers, and getting a deep under the skin feel for a business, and then making a bet into that company, and then trying to, as that company sort of showed signs of positive progression with that bit of funding, they'd look to scale their positions very quickly and take as large amount of money as they could into the business at the Series A and potentially into the B. And that's what very much the kind of the early stage VC scene was all about. The late stage scene was less prevalent because there wasn't that kind of money around. People writing a 100 to 200 million check in a Series C, D, E by the time a business got to Series C, Series D, it typically needed to look like more like a private equity profile business, and you had the more traditional private equity tech investors coming in, like a TPG, a General Atlantic, a KKR. Those are the ones who were coming in and participating. As you said, we didn't have the Tigers and the SoftBanks of this world to then continue this blitzscaling, hyper light speed approach to growing your business. The availability of capital is what dictated how companies set their stall out, their strategy, and their growth trajectory. That availability of capital has gone through a massive drought for the last, call it 18 months. I would say immediately post the summer of 2021 is when things really started to dry up, and that really accelerated in 22. But I would fully expect, and sort of from 2014, we went back into this world of, we went from the world of fundamental, hyperlocal, really reference-based investing to investing that was much more based on momentum. So who led the last round? Who was in there? What's the profile of the CEO? What are his media appearances and his media coverage like? Who else is coming in on the next round? Can I get a ticket? Can I get an allocation? And the vast majority of funds, especially when they were writing smaller funds, didn't want to have to go through the rigmarole of doing real fundamental work, and wanted to tag along to rounds that were being written by others. And the problem was that when the entirety of the market became momentum driven, is where prices started to get driven up, and you had a situation where you had auctions for Series A, Series B businesses, which was pretty much unheard of before that time, because you didn't have a situation where you had 40 or 50 different investors, or even more than 5 investors at any given time trying to get into the same business, because it was hard to discover these businesses. It was hard to formulate a conviction about them, and it was hard to follow through and allocate time to invest in them. And so with all this abundance of money in the zero interest rate period, where LPs were allocating tons of money to VC funds, and VC funds were ever growing and scaling, it just became a game of deployment. And so in this game of deployment, it doesn't pay to do it, or it didn't pay at least to do real fundamental work and really ground your investment thesis on solid fundamentals, including valuation. And so I think we've gone back to at least a period of time where we will have multiples that are more grounded in what we used to see circa 2017 and before, where there were established metrics around if your company's growing 40 to 60%, you're really in that 6 to 8x revenue multiple bucket in the private investing world. If you're growing at 100x, you're really 8 to 10, maybe even a bit above. And if you're growing more than 100x, then you're into the teens. In the next few years, if we see a very strong US economy, if we see strong Western European economic performance, and again, a loosening of interest rate policy, I can see a world where we end up going back to pretty punchy multiples. Not the same level of excesses that we saw immediately post-COVID, where we saw hundreds of millions being deployed at ridiculous valuations. But I can see a world where risk gets turned back on and multiples start creeping back up again.
I agree with you. And it's interesting to hear about sort of the fundamental work that an early stage investor would do relative to the fundamental work that a public equities investor would do. Let's switch to exits and realizing value and going public. And in particular, the 3 paths available for later stage companies: M&A, IPO, and then the SPAC. Can you give us an overview of where these markets are today for the industry, and maybe how you think about them in terms of who they're useful for?
Starting with M&A, the market is active and it's open. I think all strategics right now are larger strategics, public and large private strategics, are really thinking very, very closely about what's available in the market in terms of strategic acquisitions. I think they all recognize that valuations are not where they were a few years ago, and so now they're emboldened. They feel more confident about their ability to be proactive, to take steps forward and angle in for businesses that maybe venture capital owned, may have done a very highly valued round previously, but feel confident to be able to put forward term sheets at maybe valuations below that last valuation, but also just feeling confident about being able to put forward terms on a business and being able to transact I would say about 20% of the mandates that we have running have been driven off the back of unsolicited inbound strategic interest, which is a very high proportion. Historically, we've not seen that. It's really you going to those strategics. These are strategics that have typically been understaffed from a corporate development standpoint. You really have to make some noise to get people's attention in the organization that your business is available, actionable, and that you want to have a conversation with them. Now those strategics are being much more deliberate in terms of saying, okay, these are the bets that we want to go for and we want to action on. And so that's I think a very good sign, a very positive development. I think all companies, particularly those kind of middle-sized organizations, are now thinking to themselves, are we actually a consolidator, or will we be consolidated? Are we happy to sell ourselves in a few years' time or over the next few years? Or do we want to seize the market, scale massively, and then ultimately ourselves IPO or do something transformational? And so I think everybody's going through that existential question, and many of them are coming out to the point where they're saying, actually, you know what, we want to become the consolidation platform. The market is clearly rewarding scale and consolidation platforms, so that's the route we want to go down. On the IPO route, the market has been tepid for sure for the last couple of years. So in 2020, in terms of fintech IPOs, you had 21 IPOs. 2021, we had 29 fintech IPOs. 2022, we had 15. So far, year to date, we've had 12. Now, a lot of that is masked by SPAC activity as well. So it's not necessarily a purest number, but it does show that the IPO market is opening up again now in 2023. And I think there are a lot of companies that are working with bankers at the moment on preparing themselves for an IPO in the first half of next year. And that's being driven a lot by the fact that obviously people want a value realization event and create value in the public markets. The other problem is many of these companies, that's the only opportunity that's out there. That's the only exit. Many of them have very, very complicated preference stacks. They have very, very complicated capital structures. And so the IPO actually is the only way for them to secure further capital to fund their operations and normalize their governance structures.
The complicated preference structures, that's from, in part, kind of a hangover from the days of easily accessible capital, but lots of legal gotchas that wipe out or, cause votes for people to prejudice themselves and so on. Can you give some examples of, I think it's an interesting point, this push and pull between, I'm going to give you a big valuation, but then you're going to have a bunch of covenants that give me control of the company.
So I think the first thing to say is the people that are going to be going down the IPO route, whilst there are some that have sort of very good solid fundamentals and actually are very good IPO candidates in themselves, many of the companies that you see that will be heading for IPO have done the Series F, G, H, I, J, K, L, M, N, O, P, and have scrolled through nth numbers of rounds to be able to secure capital for their businesses. In each of those subsequent rounds, remember the default is the round that I'm doing now, the starting point for negotiations of what that round looks like from a governance standpoint is what I did in the previous round. It's very rare that you start taking away rights and privileges from one round to the next. The baseline for discussion is the previous round. So that complexity only increases from round to round. And you have things like, and as those rounds progress, the complexity increases. So you go from a place where you went from a simple, ordinary investment to being a preference investment. That preference may have been non-participating in the sense that people can either get their money back on a pro rata basis or they get the money back that they invested, to being participating, so they get their money back plus their pro rata. There can be multiple times that they can do that in terms of the liquidation preferences that they have. They can be guaranteed returns that investors get in later rounds. The beauty of an IPO is when you get to the point of an IPO, typically your liquidation preference or the complexity in the stack and the governance in the stack is dissolved because all shares effectively convert to common in an IPO. And so that gets rid of a lot of the, let's say, the financial engineering, the legal engineering that's gone into these companies on their run into an IPO.
As a last point, if you were to touch on the shape of the SPAC market, that would be really interesting as well. As we've seen lots of SPACs fall in value and become unfavored, I guess a big question is, why? Because some of these companies looked really good when they were first being positioned for a SPAC and certainly don't look as good now.
So what is a SPAC? A SPAC is essentially a company that's already gone public and got some, let's say, softish commitments for people to come and invest in the company when it finds a target to acquire. The dynamics that sit behind a SPAC or the incentives that sit behind a SPAC are quite difficult to get for an average public market investor to get their head around. I mean, you have a SPAC sponsor that effectively can take, let's say, 5 to 15% of the economics, the value of a business, just by virtue of the fact that they were, quote unquote, the sponsor of a deal. You've got banks that'll be IPOing and managing that SPAC that'll be making 2, 3, 4%, if not more, off the back of that as well. So it's SPACs are a giant opportunity for a lot of agents and a lot of agency and a lot of actors to get in on a big potential pot of fees and value and money. Now that's tied to risk, in the sense that the sponsors are taking risk and putting their own capital at risk to be able to get a transaction done. But these are typically businesses that go down the SPAC route that are not actually ready for themselves fundamentally for an IPO. And I think you have to ask, why is it that you're going down the SPAC route? Is it because your business will struggle in itself as a standalone IPO candidate, and so you're having to back into a SPAC to do this? Or is it that you're actually going down the SPAC route because the SPAC route is providing you with access to captive capital to grow your business and a faster way to get to the public market? So I think you have to have a very clear assessment of why it is that you want to utilize a SPAC route versus, is this an option that's open to us or not? Or is it just another way to go public? Direct listing, going through doing a book building, or doing a SPAC. In some ways, we're being mentioned in the same breath. They are not. They are absolutely not. And I think you really need to figure out why it is that you want to utilize the SPAC route and what you're trying to solve for exactly.
It's a pretty difficult technology to get right, but in some cases, it is the right answer, but certainly not in most. Well, Aman, this has been a really fascinating conversation. I have so many more questions, but we'll have to leave it for our next conversation. If our audience wants to learn more about you or more about Royal Park Partners, where should they go?
So our website is available and open to all. Take a look, www.royalparkpartners.com. Actually, more interesting than that, I think, is signing up to our distribution and our mailing list, where you'll be able to get our monthly, quarterly, and weekly updates on the market. We do thematic reports on a quarterly basis where we shed insight into certain parts of the financial technology ecosystem. So we strongly encourage everybody to visit our website, sign up to our newsletter, and then you can receive more point and verse with regards to what's going on in the latest on the financial technology sector.
I will second that. I really enjoyed the reports, and the work that you've done on comps and benchmarking is super helpful and useful, I think, both for investors that are trying to figure out how to price stuff in the space, as well as for entrepreneurs who are trying to have a reasonable view about the future. So with that, thank you so much for joining us today.
Great. Thank you again for having me.
Hi, everyone. That's it for this week's episode of the Fintech Blueprint. For more technical deep dives into all things fintech and decentralized finance, check out fintechblueprint.com and grab a free subscription to the newsletter. This is Lex, and I'll see you next time.